The federal corporate income tax, most people don't realize it, but it is graduated. The bottom rate is 15. It rises in stages. When you hit 34, they then say, okay, we're now going to put on a surtax and capture the benefits of the 15 and 25% rates. So for a period of corporate income, you're taxed at 39% until the 15 and the 25% rates are effectively raised to 34%. Then we push you up to 35%, and you're there for a while, and then we put on another surtax to 38% until we've got the whole mess below that raised to a tax rate of a flat 35, and then above that at $18 million, it's a flat tax rate of 35%. When we model it, we just assume it's a flat tax rate of 35%. We don't have the detailed corporate breakdown, but so much of the income is in the top bracket that it's close enough for governmental work. Okay. The payroll tax. This used to be so simple. It was 7.65% on the employee and the employer, and that's all you had to remember. Then we took the cap off the medical insurance side, and then we changed the HI tax rate for people in the upper income in the Affordable Care Act. And so what we have here is a little bit more complicated nowadays. There's a 6.2% tax for the old age survivors and disability insurance part of Social Security. 6.2% on the employee and the employer, combined 12.4%. And that goes on to wages and self-employment income up to the wage cap, which is $117,000 in 2014. It rises each year with wages, even faster than prices. Hospital insurance tax is 1.45% each on the employee and employer, or 2.9%. And that's on all wages. We took the cap off. There is now a new surtax of 0.9% on the employee only. On wages above $250,000 for married filing jointly, $125,000 for married filing separately, and $200,000 for everybody else. When you combine them, you have an overall rate of 15.3 up to the cap, 2.9 above the cap until you hit the surtax, and then 3.8 on income above the surtax. You can't read this either, it's too small, but these are the individual income tax rate schedules for 2014, and I'm sure you're familiar with what's going on here. We have the tax rates of 10, 15, 25, 28, 33, 35, and 39.6. And those brackets tell you what areas of income that each applies to. And the marginal rate, of course, the kicker, the increase in the rate only applies to the income above the threshold of the bracket. If you compared this with 2013 to 2014, you'd find all the brackets a little bit wider by inflation. That's the tax indexing to prevent a cost of living increase from pushing you into a higher tax bracket. We have a different treatment for long-term capital gains and qualified dividends, which have been subject to a corporate tax. Until recently, if you were in the 0 or 10% bracket, we would treat such things as a zero tax rate. If you were in the 15% bracket or above, it would be 15%. But recently, with the budget deal and the ACA, we've raised the top tax rate on capital gains to 20 and imposed the HI tax, the 3.8 augmented HI tax for the first time on income from capital. So there's that tax rate on top of that, and it's now an 18.8% tax rate, and if you are hit with a 20% surtax, the 20% increase in the capital gain as well, it gets you up to 23.8%. Other income from capital, it is not given the 15% capital gains differential. Gives you the ordinary tax rates up to 33%, and then sometime in the 33% bracket you end up with incomes that kick you into the 3.8% HI surtax, and eventually you get high enough income to kick you up to the still all the way up from 39.6 up to the 43.4 in the top bracket. Just as a side note on behavior, when you have a change in the tax on capital gains, in the last couple of decades, joint tax has been trying to take into account what might happen to the rate of realization of gains if you change the rate. They used to sort of ignore it or assume it was quite transitory. But as it happens, when you increase the tax rate on capital gains, people don't realize them as quickly. And when you lower the rate, people tend to accelerate the rate at which they take the capital gains, and it can have a very large effect on the revenue. In fact, it can overwhelm the change in the rate. Now, for years, CBO was assuming that it would only affect a couple of years, and then the revenue realizations the gains realizations would go back to normal, and they could then ignore it. But when they tried that during, I think, it was the 2000s, it might have been the 1990s. No, it was the 2000s. Anyway, they assumed a rate cut. They assumed a rate increase would depress the gain, but it would come back within 2 years. Well, it didn't happen. So the next year in the budget, they assumed it would take 2 years to come back. Well, that didn't happen. So in the next year in the budget, they assumed it would take 2 years to come back. If you look at their forecasts, you've got these sort of parallel lines going up over time. It's fun to watch. When we raised the tax rate in 1986 on capital gains, realizations first soared before the bill was passed, and then collapsed when the rate went up in the 86 Act. It stayed down the entire decade until the rate was again reduced under President Clinton in the mid-90s. And then it went back up. So this is a case where the behavioral assumption is very key. And this is the sort of behavioral assumption joint tax tries to do even under static analysis where they're not changing the size of the economy. If you add in the effect of the tax on the economy, you'd get an even wider swing in the revenues. But this was very important for this particular tax because of the degree to which it moves. I've shown you the estate tax rates, which of course now get up to 40%. Take a look at it on the web to get the idea of the graduation. Now there is a large estate tax credit, now $5 million, which means that the bottom rates are simply negated. The tax owed on the first $5 million just doesn't happen. And so we start very high up in the rate structure when you hit the first dollar of taxable estate. The ratio of the marginal to the average tax is quite enormous. You're taking a very high amount of a very small base instead of a very small amount of a very large base, which, as I've pointed out before with the damage from the tax rising with the square of the tax rate, is an inefficient tax that does more damage than it has to raise a certain amount of revenue.